Welcome. All of us at Wespath hope you enjoyed the 4th of July holiday and have had a nice start to your summer. I'm Frank Holsteen, Managing Director of Wespath's Investment Management Team. We oversee the management of Wespath's investment funds, and I'm here with the latest edition of our quarterly review series. Over the next few minutes, I'll touch on a few stories from the second quarter, including performance of U.S. and international markets, recent market trends, including the investor excitement around artificial intelligence, and the latest news surrounding inflation and the U.S. Federal Reserve. Let's start with market performance. The second quarter closed with mixed results for global financial markets. U.S. equities, as measured by the S&P 500 stock market index, rallied nearly 9% in Q2. International equities were also higher, with the MSCI EAFE index up 3% and the MSCI Emerging Markets Index up 1.6%. On the other hand, the Bloomberg U.S. Aggregate Bond Market Index fell almost 1% on the quarter. One of the biggest market headlines in Q2 was the uncertainty surrounding the U.S. debt ceiling. The situation was finally resolved in June as Democrats and Republicans agreed on a 2-year deal that required compromises on both sides. This agreement was struck just days before the government may have run out of funds. The compromise avoided what may have been significant market volatility. Another important topic in Q2 was the strength of large technology company stocks. One example is NVIDIA, a computer chip company. NVIDIA's stock gained 52% in the quarter and is now up over 189% so far this year. NVIDIA is a leader in the artificial intelligence, or AI, market, and its recent performance underscores growing investor excitement about the widespread adoption of AI. In fact, NVIDIA and a small group of other stocks that could benefit from AI have driven most of the overall returns of the U.S. stock market in 2023. Market pundits have dubbed this group the Super Seven. It includes NVIDIA, Facebook's parent Meta, Tesla, Apple, Amazon, Google parent Alphabet, and Microsoft. As we can see, these stocks are significantly outperforming the 493 other companies in the S&P 500 index. In addition to these stocks, markets continue to be influenced by two things we've talked about a lot recently: inflation and the Federal Reserve. U.S. inflation, as measured by the Consumer Price Index, or CPI, eased to 4% year over year in May. That's the lowest CPI reading in 2 years and well below the June 2022 peak of 9.1%. However, it's still well above the Fed's ideal 2% target, and there are reasons to think inflation may still prove to be sticky. For example, U.S. employment remains strong. The latest jobs report from May showed unemployment at 3.7%, and wages up 4.3% year over year. This persistent strength in wages and the labor market may keep inflation higher for longer. And as always, markets are most interested in the Federal Reserve's response to inflation. Ideally, the Fed is trying to create a soft landing, or a slowing of the economy and inflation without creating a recession, turmoil in the job market, or a sharp decline in financial markets. This is a tough task, and many investors have eagerly anticipated an end to the Fed's rate hiking. The concern is that the Fed will overshoot or do too much to cool inflation, and that the economy heads into a recession. It's difficult to predict whether a soft landing or a recession is on the horizon. Fed Chairman Jerome Powell indicated recently that we can expect a couple more rate hikes before the Fed stops raising rates. And as mentioned, the employment market remains strong. We've also seen decent economic growth so far this year. That could change, but the economy has shown resiliency up to this point. We'll keep you updated on the latest as we head into the second half of the year, and as we always mention, regardless of near-term unknowns, we're here to keep you informed and remain committed to our long-term focus.